Hey, what's up, stock compounders? Brad here. So it is that time again for our weekly Q&A. Thanks to everyone who asked a question this week. Let's jump right in. So Jake asks, you recently mentioned in your last video that you don't like home builders. However, I was wondering if you've looked at MTH, Meritage Homes. It seems pretty interesting with respect to potentially being a spawner. Not only do I think it is one of the better home builders out there, but I think it's selling at a discount. So I haven't looked at MTH. I've never invested in a home builder. I've never really looked at home builders. Um, Pabrai did mention, was it NVR? I think that we're just buying back a massive number of shares over the years. And the company had a great performance. It's just not really an industry that I pay much attention to. So maybe I'll take a peek at this. If you want to maybe throw a few more selling points out there that might encourage me to take a closer look. Thanks, Jake. Frank asks, what do you think about net nets? Do you think it will still be a viable strategy over the next 10 years? So, for those who aren't familiar, let's talk about what net nets are. So, Benjamin Graham was big on net nets. Here's the formula for net current asset value per share. So, basically, a net is buying at less than the net current asset value per share. According to Benjamin Graham, investors will benefit greatly if they invest in companies whose stock prices are no more than 2/3 of their net current asset value per share. And in fact, a study done by this university showed that from the period of 1970 to 1983, an investor could have earned an average return of nearly 30% by purchasing stocks that fulfilled Graham's requirements and holding them for 1 year. So this is kind of like a bit similar to the magic formula back in the 1970s when the study was done. Yeah, I think it's a way that you could find compelling investments. This holding for 1 year gives me pause. I don't like to hold things for 1 year. I like to hold them for a decade or longer. And then at the bottom here, Graham says, Graham made it clear that not all stocks chosen using this formula would have strong returns. So it's really a diversified approach. And I just want to share one more thing here. So this is a big issue. The reason net stocks may not be a great long-term investment is simply because management teams rarely choose to fully liquidate the company at the first sign of trouble. Okay? Just because you have a lot of assets on the balance sheet does not mean the value of those assets are going to flow to the shareholders. In the short term, a net stock may make up the gap between current assets and market cap. However, over the long term, an incompetent management team or a flawed business model can ruin a balance sheet quite rapidly. Okay, and that's a really important point to understand. I think that's really what kept Monish Pabrai out of, I can't remember if it was Sears or if it was Seritage back when, Sears still owned those properties, or at least the Seritage properties, were there was a stake by the Sears shareholders for those. And Charlie Munger pretty quickly talked Monish Pabrai out of that investment for this reason. Just a management draining the balance sheet over time. So, if I were to use a strategy like net, I would definitely pay attention to management. Absolutely. And obviously, it's a lot harder to find nets today, especially in the US, than it was in the 1970s, because it's so much easier to access financial information and quickly screen for different criteria. So, thanks for that question, Frank. Derek, can you do a video on Howard Marks' investment in Vistra Energy Corp? It's his biggest investment and a deep value play. Let's take a quick peek here. Howard Marks. So we're going to search for Oak Tree So Vistra, it looks like it's right behind the Array Technologies position. Pretty far behind, actually. I believe it's the largest position in the 13F filing. Array was a recent IPO, and so I think it didn't show up in the 13F. But Vistra, let's see what they do. Engages in the electricity business in the United States. Company retails electricity and natural gas to residential, commercial, and industrial customers. Okay. Again, this isn't an area that I have much experience with either. So I probably won't be looking into Vistra, but I appreciate the heads up that might be an interesting deep value play. Jordan, how are you calculating intrinsic or fair value? 10 cap, margin of safety, payback. So I like to use a discounted cash flow valuation using free cash flow over 10 years. Is typically what I do, which, similar to margin of safety, but I like to take kind of a whole business perspective. I believe Philtown's margin of safety, these are all kind of Philtown valuation approaches. Margin of safety uses earnings per share to back out kind of a fair value on a share basis. I like to look at the whole company, which includes kind of how much debt the company has taken on, not just the equity. So that's my preferred way at this point. But I mean, the more methods you can use to try to figure out what a business might be worth, the better off you're going to be, because you're going to understand, various aspects of the business by approaching it from different angles. I would like to ask you, what's your opinion on Markel and Thomas Kaellner? I know Monish Pabrai has respect for Thomas Kaellner. It's one of the managers he looks at for the free lunch portfolio. I really have not done a deep dive on Thomas Kaellner or Markel Insurance. If any of you have any particular knowledge about Thomas Kaellner or Markel, like the long-term kind of history, what you like about Thomas Kaellner, let me know in the comments, because I would like to learn more about him. So thanks for that question. Which is the business that is closest to your target buy price? Well, I made a video not too long ago, actually, was it yesterday, about Shinnikin, and I've made one previous to that. I have started kind of buying Shinnikin in Japan, but in terms of U.S. companies, or at least companies that can be bought through U.S. exchanges, Alibaba is closest to my target buy price. Somewhere in the 200 teens is where Alibaba is going to start looking pretty interesting to me. I think it dropped down to 230 recently, and then it popped back up. It might be somewhere around $240 per share now. So there's two answers for you. Thoughts on Shinnikin? Thank you. I just made a video yesterday on Shinnikin with my thoughts. Where can we find Liyue investment letters? An investment Twitter account claims they read them but never replied when asked to share them. Can you do a video on HK 1658 as well? That's Postal Savings Bank of China. I recently kind of did a video on how to find out what guru investors in China own and recently purchased. So, yeah, Postal Savings Bank of China. So I don't invest in banks. Okay, I've never invested in a bank. Whenever I try to do an analysis on a bank to understand a bank, it's just too hard. I can't get comfortable with it. So I'm not going to look at Postal Savings Bank of China, but certainly could be a compelling investment since Liyue has been buying recently. And I don't know, I would love to read Liyue's letters to his investors. I didn't even, I mean, I guess he writes them. I hadn't even really thought that he writes them because I've never seen any. Um, but yeah, now that you've planted a seed, now I'm going to be kind of on the lookout for uh, how to find these letters from Liyue. So cheers for that. Cheers if it works out. Uh, Darn you if it doesn't, because I'll probably waste a lot of time trying to find those. Is book value to price, or price to book value, an important metric when evaluating a stock? So when I look at Berkshire, price to book is a number that kind of gives me a sense for how Berkshire is priced as compared to its intrinsic value. But you've really got to understand a business in order to use kind of these shorthand metrics that people throw around for getting a sense of, you know, how is the company cheap? Is it expensive? So there aren't really any shortcuts. Now, once you really understand a business, then you can identify a few metrics that are useful to track over time and get some information from those metrics. But I think if you're just doing a screen for low price to book companies, I think that's probably largely a waste of time. So that's how I'll answer that one, Bill. David, how do you balance staying within your circle of competence against stretching to develop adjacent competencies? Yeah, well, I'm always learning. I mean, I'm very curious by nature, and so that naturally kind of grows my circle of competence. So I don't even really think much about my circle of competence. Um, but for me, it's really all right at my gut, at a gut level. How comfortable am I with this company? That I understand it, that I can see where it's going to be 10 years from now. So I don't know. I'm not quite sure how to answer that one. I think the idea of a circle of competence, um, it doesn't quite resonate with me. But obviously, great investors have used the term. I think Graham maybe started it, Buffett, Pabrai, they all use it. It makes sense, right? It's a framework that makes sense, but I don't spend much time thinking about it. I think as investors, we need to be continuous learning machines, which in a sense means we're always kind of expanding our circle of competence. I have a few questions on discounted cash flow. Okay, DCF. Why do you use a 10% discount rate instead of 15? I've used both in the past. Recently, I'm using 10% just because, I think 15%, it excludes a lot. I think it's a little bit too conservative for my taste. So I'm more comfortable with 10, especially, in an environment that we're in with, real interest rates being so low. I think if you're demanding a 15% discount rate, it's going to be real tough to find things, which isn't necessarily bad, right? I think we should be unreasonable as investors, but I'm comfortable with 10%. Since 5-year company growth rates are easier to determine, do you see any issues with using a 5-year discounted cash flow instead of 10? Well, so when I'm buying a business, I really want to own it for at least 10 years. Okay. So, that's the main reason I use a 10-year kind of DCF, because I want to be thinking about the business in a 10-year or longer time horizon. But there's probably no issues with using a 5-year. I think it's mostly personal preference. For some reason I paused when I saw 5-year company growth rates are easier to determine. I don't know that that's necessarily true. Okay. And I'm not going to go deeper into that. There's just something in my gut is saying, I'm giving a little pause. Obviously, I understand, 5 years is closer than 10 years. So theoretically, it should be easier to, project that. But there's something that's, I don't know, a little off to me about that. Question 3, why do you use free cash flow in your DCF instead of owner earnings? Well, free cash flow is easier. Free cash flow is easier to calculate. In fact, it's calculated for us. Obviously, we want to know exactly what's going into that calculation. But I think owner earnings is a very worthwhile exercise, calculating kind of the owner earnings, like a 10 cap method to value companies. Supposedly it used to be, I don't know if it still is, one of Warren Buffett's favorite ways to, kind of most accurate ways to value a business. Sorry guys, this froze. I just want to mention here, this has been freezing a lot recently, and I own a MacBook Air, okay? And, Apple, I believe, is the most valuable, at least based on market cap, business in the world, okay? So I don't know, maybe it's something I'm doing on my end. I'm not taking good enough care of my MacBook Air, but I'm a little annoyed that keeps freezing. And I kind of want to blame it on Apple, just so you guys know, just so we're all on the same page. Rick, hi Brad, how would you balance letting your winners run versus selling down to the sleeping point? So I'm not familiar with sleeping point. I don't know what that is. So Rick, maybe clarify that. I'd be curious to know what that is. I bought with a 90% margin of safety. That's awesome that you found a company with a 90% margin of safety, which is now at a 50% margin of safety, right? So it's gone up 5x. Fantastic. But due to the 5x, the position is now half of my portfolio. So Monish Pabrai spoke on this in his last talk. I believe it was to Georgetown. And he was talking about how, if he had bought Amazon early on, and Amazon had grown to be 95% of his portfolio, he would be comfortable having Amazon at 95% of the portfolio. He would not be selling down that position. Now, that's obviously, easy to say theoretically. It would probably be quite challenging for a lot of people to have 95% of the portfolio in one company. Maybe it wouldn't be as hard if it was a company like Amazon, or I should say, if it was Amazon. There aren't many companies like Amazon. So my advice, or my, how I would answer this question is, and this is how Pabrai answers it. I'm a shameless cloner, so I'm just going to parrot what Pabrai says. If the business is getting better, if it's a business that you really like, that you want to own for the long term, you think it's a great investment, you think it's going to compound your capital for you, if the business is getting better, don't do anything, okay? You're just hurting yourself by tinkering with the portfolio if the business is getting better. And I like that. I really like that framework for it. So, if the business is getting better, if it's a great business, let it ride, okay? If it's not a great business, like if you're buying a business with a 90% margin of safety, if you're paying, 10 cents to buy $1 bill, maybe it's not a great business, okay? So you've got to figure that out. Is this something you want to own long term? Or is it something you just bought because it was so cheap? Maybe you take some off the table if it's now at a 50% discount to fair value. So that's, there's kind of got to do some soul searching on, how you feel about the prospects of this company, whether you want to own it for the long term. Any thoughts on the 3 tools, MACD, stochastics, moving average, from the Rule 1 book? That was Phil Town's first book. Did you try to apply them? Do they seem to work? How reliable are they? So I read Rule 1, and then I think immediately after it, I read Payback Time. And in Payback Time, I think Phil Town really gets away from these technical analysis methods for getting into and out of companies. So I never really got into them because it seems like Phil isn't really using them anymore. So, and I've heard from students who have taken courses by Phil Town recently that yeah, he's not really teaching that stuff anymore. So, I've taken a pass. Charlie and Warren play bridge and seem to be passionate about it. Do you think this is because they are old? Yes. Or because the game utilizes some sort of investing skills? Yes. Bridge is a game. I've been wanting to learn bridge probably for like 2 years now, and I haven't taken the plunge. But my sense of bridge is that it's very similar to managing a portfolio where you're constantly weighing probabilities, opportunity costs. I mean, I think my sense of it is it's a pretty good simulation, at least in terms of how to think, as compared to the stock market, at least managing a concentrated portfolio. So, yeah, they're old. Bridge does seem to be a dying game, but I think it's probably one of the best games to learn to improve your investing. Great question. What's your take on valuation of high price to earning growth stocks, supposed to be industry disruptors, with no or very low current positive cash flow? Are we moving away from traditional value investing rules toward a new paradigm shift? It's a great question. So it seems like whenever we approach kind of the bubble end of a market cycle, this is what happens, right? These companies that have great stories but aren't really making money are the companies where the price gets driven up and up and up, okay? Because that's what happens in a bubble. People get so focused on FOMO, fear of missing out, and so they gravitate towards the businesses that have the greatest potential, right? Potential meaning they don't have the track record, they don't have the earnings today. It's these stories, right? These story stocks. So, and of course, every once in a while you get an industry disruptor out of these story stocks, and that fuels this fervor to buy these story stocks, right? Because every once in a while one hits. But to me, it's not so different than playing the lottery, okay? I mean, I think ARK Invest, Kathy Wood, there's some similarities there to playing the lottery. It's not quite like playing the lottery as we're used to thinking about it. It's more like a venture capital firm making kind of 1% bets on 100 different companies, knowing a couple of them are going to turn out really well, and that's going to pull the whole portfolio up. But that's not my game, okay? I like to be kind of a concentrated portfolio of 10%, sometimes even 20% positions. So this just doesn't work for me to take these long shot swings. So that's how I'd answer that. I don't think it's a paradigm shift. I think the pendulum is going to swing back once there's kind of a downturn in the market. I think it's just based on where we're at in the market cycle that these high price earnings growth stocks are really getting a lot more attention than the more typical kind of value stocks. What are your thoughts on adopting a simple approach of analysis as per our good friend Phil Town? I love simple. I think the simpler, the better, as long as it gives you results. His approach is very easy to follow, and the financial data required is very easy to track down. I love this approach because of its simplicity, and it has proven successful. So, okay. I don't know. I don't think we know if it's proven successful. All right. Phil Town's approach. Phil Town, I don't believe, has published his results, his performance over the last 20 years. And this has been pointed out kind of in different videos on Corner of Berkshire and Fairfax. I don't know that we know that his approach works. The second thing I will say, I mean, his approach makes sense, right? It's kind of value investing 101. It makes a lot of sense. But another point I want to make is if you look at the companies in Phil Town's portfolio, he's not always following his approach. I would say most of the companies in his portfolio, and I haven't done a deep dive on, more than a couple, but it seems like if you run those companies through the Rule 1 toolbox, the Rule 1 screener, they don't do all that well, okay? So, I think Phil Town created this approach for the masses to follow. It's kind of going to keep you out of trouble. But Phil himself deviates, I think, quite frequently from the tools that he has created. Just wanted to throw that out there. I'm a big fan of Phil Town. I really appreciate all of the education that he's done for, investors. I think it's fantastic. But I just want to point out those two things. And it can be very difficult, actually, to find investments that fit in with the framework that he's pitching. Because it really is quite unreasonable to demand, a 50% margin of safety and demand, these really high growth rates for revenue and earnings and equity. It's especially where we are in the market cycle now. It's very difficult to find things that fit into that. We could probably go to some emerging markets and find things that fit into that there, but those you can't plug those into his screener currently. It's just for U.S. companies. So appreciate what he's doing. I think you've got to figure out what works for you, and go deep on Phil Town stuff, right? And then maybe expand beyond Phil Town. Look at other investors and figure out kind of your own system, what works for you. That's what I would say. But I do love simplicity. I think the simpler the investing approach, as long as there's reason to believe you can generate alpha, you can outperform the market using that approach, I'm all for it. I am fine, thank you. I would like to ask you, what are the methods that you are using or looking on before investing in any company? And are these methods can be used on all market caps? Based on your last video, you were looking on small cap, like Redbubble. Are you going to invest even though the PE ratio is above 40, or do you prefer to be less, even if the expectation of growth is high? What is your perspective in this case? Thanks for the question. So the methods that I am using. So first, there's a couple. First, I want to know, does a super investor own it? Okay, does a great investor own the business? If there aren't any super investors that I respect, any great investors that I respect that own the business, there's too much risk, quite frankly. I don't need to go outside of those companies that have been pre-filtered by some of the smartest investors in the world. Okay, I think as a beginning investor, in fact, for most investors, even great investors, I think that's a very good starting point. And then it's just about drilling into the business. You can read what other smart investors have written up about the business, read the annual reports. If you can hop on an earnings call with the management team, just to hear, what questions are being asked, how management answers those questions. There's no shortcut, really. So, you know, that's my answer to that. And in terms of Redbubble, I did a little digging on Redbubble. Um, there's a metric, I forget what it stands for. GPAPA, GPAPA. Okay, it's a way to value these two-sided marketplaces, like Etsy or Redbubble or eBay. Um, and it looks at kind of, I think it's earnings after you account for what the company spent on, advertising to generate those earnings. And Bonsai Partners bought Redbubble, I think, at a 4 enterprise value to GPAPA. Okay, it was like 4. Now it's 15. Okay, so at 15, I'm a little less excited to get into Redbubble than I would have been at 4. But it's great. It kind of brought to my attention that way of valuing a two-sided marketplace like that. So again, continuous learning machine. That's the name of the game. JJ, do you ever wish someone told you about investing in your 20s? You would probably be a millionaire at your age of 40. I'm not quite 40, JJ, but you are very close. I turned 40. Jesus, what is it? In like 3 months. That's. I'm gonna have to come to terms with that, perhaps, but that's another video. Absolutely, but just someone telling me about investing in my 20s, I don't know that would have done much for me. What I wish is that I would have discovered, Buffett, or that I would have discovered Pabrai or Charlie Munger in my 20s and learned the lesson of the magic of compounding in my 20s. If I could have gotten that lesson, the magic of compounding, combined with kind of a value investing approach to the stock market, absolutely, I wish that would have come to my attention 2 decades ago. It does suck that people don't learn this stuff in school. I think one of my legacies is going to create a program, maybe an after-school program, maybe it's a summer program, where kids can come and learn about investing and, finance, managing money, your own money. It's so needed. It's ridiculous how little we learn about money from school. And we learn a lot from our families, but not often in like a direct way, not in an intentional way. We learn whatever kind of money framework our parents usually got downloaded from their parents. It's just so unintentional, and it's so it drives me crazy how important money is in our world and how little attention is paid to it. You just think about being a student going to college, right? And you have this huge student debt. A lot of students have a huge student debt when they graduate from college, which is the opposite of really what you want as you leave college or high school, if you don't go to college, and enter the world. Having that, 5-figure, 6-figure shackle around your ankle is just a terrible way to start off. So, yeah, this is a topic that gets me pretty riled up. So much compounding missed. I am so grateful that I learned about this stuff before my kids were born, because at least now, I can kind of start them with some seed money and teach them very early about the magic of compounding. Whether or not they care, whether or not they do anything with those lessons is up to them. It's not really something that I can control. But to have that opportunity, I'm very grateful for. So even though I missed the boat, there's always another generation that doesn't have to miss the boat. That was a long answer to that question, but I may be inspired to make a video about that topic now because clearly I feel some things around it. Last question. Do you think Peter Schiff's investment strategy is any good? So I have no idea what Peter Schiff's investment strategy is. So if you want to leave me a comment on this video, kind of give me some details about what Peter Schiff is doing. My sense of Peter Schiff is that he's kind of an efficient market hypothesis guy. Maybe that's wrong, but off the top, I don't have a whole lot of interest in what Peter Schiff is doing based on what I've seen from him in the past. But let me know what's Peter Schiff got going on. So anyway, guys, that's all I have for you guys today. Awesome questions. Love them, love them. Keep them coming every week. I'm going to do these Q&As, and it's just so much fun. It's a great way for me to spend Saturday night or Friday night or whenever I record these Q&A sessions. So that's all I got, guys. I will see y'all in the next video. Take care.